Well, there is broad brush statements that the dairy industry is debt-laden and over-leveraged, but our next guest, the Timaru-based director of NZAB Rural Banking, Andrew Lamming, has delved into the financial statistics and believes it shows a different picture. And Andrew joins us now. Evening, Andrew.
How are you going, Sarah?
Good. Now, we know our dairy farmers are not only passionate and hard-working, but they have been focusing hard on laying down that strong cash flow onto their balance sheets. What did you find out as you looked into how things are going in repaying debt in dairy?
Yeah, well, I suppose just going back a couple of steps, Sarah. I mean, we work in the industry every day, work across farmers where they borrow $1 million or over $100 million. And I suppose what we've been seeing over the last few years is the ongoing theme of dairy being over leveraged, which has actually been correct in some quarters, but over the entire industry we were a little bit more sceptical about whether or not that was true. And I suppose what we were really concerned about was the impact on farmers' confidence and also those that were seeking to invest into the sector as well. So what we did, we dived into the Reserve Bank data and the Dairy NZ data to look at the industry as a whole, and probably found that when you look right across the industry, it was probably not as leveraged as maybe what the commentary would suggest.
And so just looking here, there's some fantastic graphs in the last week's Farmers Weekly and, of course, online farmersweekly.co.nz. Is interest rates, low interest rates really contributing to a lot of this?
Yeah, in part. The first trend probably to look at is just the fact that farmers have repaid a lot of debt, over $1.5 billion in the dairy sector in the last 12 months alone. Now that's a tremendous amount of money when you're actually used to the fact that debt in the agri sector is going up 5 to 10% every year. Even more so when you look at, say, the home loan sector or the commercial business sector, where in the home loan sector over the last year they've gone up between $15 to $20 billion. So farmers are using this great profitability at the moment to repay down debt like never before. It's really neat to see. So that's the first thing we looked at, I suppose, when examining that, is just overall sector debt coming down.
And with regards to yields, there must be some great interest in potentially buying into dairy again from an investment perspective?
Yeah, that's another thing we examined, and it's not really a measure of leverage, but I suppose it was worthwhile looking at how these farms are performing relative to their asset value. So we did just a very simple analysis against government bonds, which are generally regarded as relatively risk-free. Now, you'd never expect them to track exactly the same way, but the gap between them has got quite different. And what we're seeing now amongst dairy farms with long-run average payouts is they're actually yielding between 6 to 8%. And which is actually not significantly higher than long-term averages, but it is in the context of government bonds or interest rates or alternative investments now being in the low single digits.
And in regards to production of kilo of milk solids annually, it's great to see that production has remained the same and debt has come down considerably.
Yeah, and so by default, then debt per kilo has come down. And I suppose with payout still tracking at that long-run average and actually increasing a wee bit over time, we're now sitting around about sort of $6.30, $6.40, and also with low interest rates now for the last sort of 3 to 4 years and tracking lower, interest coverage, or the amount that a farmer actually pays in interest relative to his overall profit, has gone down. And I suppose that's a key measure to actually see whether or not a business is leveraged or over-leveraged or under-leveraged.
Well, it's interesting too because, we've got some very risk-adverse banks in New Zealand in the agri sector and environmental regulations and uncertainty is certainly driving that. But you're saying that the yields are there for those who can get over that hurdle.
Yeah, the yields are there, and it doesn't necessarily mean that they're not justified. There are a number of headwinds in the sector, the environmental uncertainty, even asset value uncertainty at the moment as well. But I suppose what we're seeing is that gap or that level of performance, which is contributing to those high yields, almost feel like those that it's getting too far away from some of those lower risk-free returns that you see or compare against. So there's a lot of good happening in the sector at the moment, and I suppose when I step back and think about confidence waning a bit. They've had a few headwinds with environmental, but the amount of profit, our farmers at the moment have been through, just finished their entire FY20 financial results, and we're seeing some of the best ever results in the industry. It's really quite exciting.
Fantastic. Great to hear. Now, while I've got you here, let's talk about OCR. Now, a lot of the banks say, don't think we're going to pay you to take out loans. Negative interest rates being passed on may not be one tool of Adrian Orr's, but how do they pump that cash directly into the economy?
Yeah, well, it's got a lot more complicated than it used to be. I mean, go back 10 to 15 years, changes in OCR actually meant a heck of a lot when it came to borrowing costs, and they still have an impact. But the reality is, too, is that most banks actually get their funding locally or offshore, so the cost of their deposits actually determine what the borrowing rate is. Now, the cost of deposits actually do go down in line with the OCR, or generally do. So I suppose what happens is when the OCR goes down, it's supposed to go possibly further. There's a couple of banks right now talking negative 0.5. ASB and ANZ came out this week and said that. So it's whether or not the deposit book will actually follow down to levels like that. In saying that, there's actually a new policy which has been mooted by the Reserve Bank called funding for lending. And what they're attempting to do is make sure that the OCR, or funding at the OCR level, more directly comes across by way of the actual cost of funding to the banks and therefore to the retail customer. So what you might see, for example, is an OCR of minus 0.5%, and actually banks being able to access funding at that level too, because effectively the Reserve Bank is actually generating money for the banks at this level. Now, this is only very, very new and only being talked about at the Reserve Bank in the initial stages. And also it's worth noting that it may not be for agri or business, it may be more for the retail sector. But nevertheless, anything that brings down the cost of funding across the entire banking industry will be good for borrowers.
Do you believe we may see a swing in more New Zealand investment into our farms?
Well, look, I actually hope so. I mean, you actually think about investment. You've got a number of different sectors to invest into, and all of a sudden you've got one which is almost appearing like an outlier. You know, dairy farming and even all types of farming are returning very well versus commercial properties or equities, or the dividend component of equities anyway. So I think it will definitely become more attractive. I think where it becomes a bit more complicated is actually accessing that investment. You know, like you can go and buy a residential house, you can buy a share relatively easily. Buying a dairy farm is obviously a bigger chunk of money, and finding someone to manage it is difficult too. But in saying that, the market generally solves these things. We've had equity partnerships in the past. We're having more and more lease backs these days, and so it'll be different ideas that come to the market, I suppose, to capitalise on an ever increasing yield. Or an investment play in the sector.
And it certainly may help a lot, as you said, equity partnerships, because it needs to stack up better on paper when it comes to those types of more complex agreements for the cash-strapped young fella or girl getting into these farms as well. So that's quite exciting to see that the tables have turned.
Yes.
Andrew, what would you say, sort of predicting in the next 6 to 12 months around where things could go and banks' appetite for lending?
Oh, look, I'd like to think appetite would get better, but I think we're still in a period of banks looking for repayments. Despite what I said before about leverage in the sector being not as bad as what people thought or think, there are still plenty of farms and farmers that are, just like every other industry. There are still some other headwinds too, like the Reserve Bank capital ratios, which mean that lending to the sector is not as profitable as other sectors like home lending. So those things aren't going to fix themselves overnight. Now, in saying that, there is still a very active market by way of banking out there. Not all banks are participating in terms of actually new-to-bank customers or supporting additional growth, but that does by no stretch mean that no banks are. And they are still looking to support very good operators who can do it with a good track record, who've got good systems going forward as well.
Thank you so much for taking the time to join us. Andrew Lamming is a director at NZAB Rural Banking Service, and of course some fantastic financial commentary there. Dairy Not dismal is the article in Farmers Weekly. This is Sarah's Country.